the election and enrollment process with seed cotton last year. Seed cotton has come back again in this farm bill. And then what you look at as far as payments with ARC PLC, you look at base acres on a farm, and that's based on a prior planning history on that farm. And so looking at base acres, however, with this farm bill, there is a change about base acres. If it was the cropland acres were planted entirely to grass or pasture, including idle or fallow from January 1, 2009 through December 31st of 2017, those base acres will stay on the farm. However, under this farm bill, they're not eligible for payment. So you're looking at the years 2019 through 23 that just basically acres planted to grass is not eligible for ARC PLC payment. Any unassigned base acres left over from last year that were not allocated, the generic base acres, and you know the generic base acres were our old cotton base acres, and before they came back as seed cotton acres. Any of those that were not allocated last year, they're going to be ineligible for payment. And payments under the ARC County and PLC are equal to 85% of the covered commodity base acres. So you're going to take your total covered commodity base acres, multiply that by 85%, and that's going to be your payment acres for ARC County and PLC. For the ARC individual, that rate is somewhat reduced. You're looking at 65% of the base acres that are eligible for payment. Farms that have less than 10 base acres, and this would be total base acres that a producer has if they have multiple farms. If they have less than 10 base acres, then those are not eligible for payment unless the producer falls into one of the groups, with the exception of socially disadvantaged farmers, limited resource farmers, beginning farmers, or veteran farmers. Then they would be eligible to receive payments if it's under 10 base acres. And the ARC County, the yields, election yields are based on yields where the physical location of the tract, the actual benchmark yields are established using RMA, either RMA yields, it could be NASS, National Agricultural Statistical Service, those yields, or other sources that the FSA State Committee uses. We do use Extension Service yields. We do get quite a few from those that there's not yields for RMA or NASS data. And those are effective for 2019 through 23. And PLC in 2020, there'll be a one-time opportunity for owners to update the PLC yields, and they'll be updated based on a percentage of the producer's yield. And those are effective the year you make the change in 2020, and it's good till the end of the Farm Bill of 2023. And when election is made on the farm of where to enroll the base acres, or when it's time to make the election, then all producers on that farm that have an interest in the base acres, they have to make a unanimous decision on how to enroll the farm. And this will be effective until the 2023, the end of the Farm Bill. And beginning 2021, election changes are allowable. If you enroll a crop in ARC County, and then in 2021 you want to change it and enroll it in the PLC program, then that's allowable. So for 21, 22, and 23, you can change elections. And failure to validate election in 2019, under this sign up, if you don't make an election, it's just going to default. If it was enrolled in the program last year, you're going to get the default of what you had for 14 through 2018. And 2019 payments for those unelected covered commodities are prohibited. If they're not covered commodities, do not have an election, then they'll not be able to get a payment. And the enrollment, now that was the election part I talked about, which program the covered commodity is going to go in. Now you have to come in annually and enroll, do a ARC PLC contract. That's required annually for if you have a share interest in the base acres. Must enroll 100% of the covered commodities. If you don't, then those unenrolled covered commodities will not get a payment. And the enrollment dates, this year we started September the 3rd. That's for 2019 enrollment. And then 2020, we're supposed to start yesterday, October the 7th. And the 19 enrollment period will end March 15th of 2020. And then the 2020 enrollment will end next June. And so thereafter, every year, the sign-up's going to start in October and it's going to end March 15th of the following year. And then a couple of RMA insurance products that can be affected by enrollment in ARC PLC. Supplemental coverage option. If you elect and enroll in PLC, still have the option to purchase supplemental coverage. If you elect ARC, it's ineligible for the supplemental coverage on the planted acres. And then for stacks, the stacked income protection plan for cotton. If seed cotton base acres are enrolled in ARC or PLC, then it's ineligible for stacks on the planted acres. But however, you can enroll other covered commodities just as long as it's not seed cotton. And payments, it depends on what the market's doing, whether ARC PLC payments are triggered. So if it is triggered, 2019, you're looking at payments being made in October of 2020. And pretty much every year, you're looking at the following year of ARC PLC payments being made. Just like for 2018, we'll be making ARC PLC payments this month for 2018 ARC PLC contracts.
So I'm just going to give a little bit of an insight into the ARC PLC program, and ultimately when we start talking about the other programs, discuss some of those as well. And just disclaimer from my perspective, the University of Georgia, this is based on my reading of and understanding of the rules and regulations of these various programs. And so focusing on that Farm Bill, I'd like to kind of take a step back momentarily and look at what under the 2014 Farm Bill, what that election was in terms of ARC and PLC base acres. And so this was after the seed cotton conversion, just for Georgia. And you can see there the percentages that shows ARC County versus PLC. Of course, we know for peanuts, almost 100% there in terms of PLC, but some of the other commodities were split between that ARC County decision and the PLC decision. That unassigned generic base, that is something that under the 2018 Farm Bill will not have any payments, and so you could see 4.3% of the total base acres in Georgia will ultimately not have any payments there, but about 2/3 on the PLC and about 1/3 on the ARC County. And this is important because one of the default options, if no producer in Georgia does anything, then ultimately this is what would remain. This is what would stay under the new Farm Bill in terms of this allocation. So it's very important to think about what those options are between ARC and PLC and ultimately look at what the best decision is for your particular farm. So just to review in terms of the PLC program, the formula for the PLC program essentially stayed the same except for the one component of the effective reference price instead of just the reference price. Not going to go into great detail here on the effective reference price. We do have some information that's available on our website, but effectively it is for crops that are relevant to Georgia, there's really nothing to talk about on that effective reference price. We're looking at just the reference prices that were the same as what they were under the 2014 Farm Bill. So that PLC payment rate is the difference between that reference price and the higher the marketing year average price or the loan rate, which of course that marketing year average price is that national price. And then those payments are based on the PLC payment yield, the base acres, and 85% of that. So that stays pretty much the same as where it was. The ARC County program is based on the benchmark revenue and is an income or revenue program as opposed to just a price program. So it's a combination of the price and yield. And there it's focused on the Olympic average marketing year price for the 5 most recent years that are available. And that word available is kind of key in terms of the formula for the Ark County program, because the way it was instituted before, essentially it was the previous 5 years that if we were looking at computing a benchmark revenue and looking for that marketing year average price for 2019, we would go back to the 2014 through 2018. But with that word available in there, they actually made a shift. Excuse me, to make those calculations and the benchmark revenue data available early in the marketing year, there's a shift, so it's going to actually be the 2013 through 2017 marketing years in terms of prices and yields, the county yields that go into calculating that formula. So that's a little bit of a change this time compared to where it was under the 2014 Farm Bill. Remember though, this benchmark revenue is based on that, again, that national average price, and then also county yields. So the average county yield, or 80% of the T yield, whichever is higher, and with that Olympic average, drop the high and drop the low, average the remaining 3. That benchmark revenue goes into the computation for the payment for the Ark County based on what the actual revenue is, but recall it's not the actual revenue for your individual farm, it's based on that county yield. So again, this is a county-based program, so that actual revenue is the average county yield for the year times that marketing year average price. And you ultimately get that payment rate, that's the difference between the revenue guarantee and the actual revenue. So to make your decision, you need to be, between PLC and Ark, you need to be thinking about what your PLC yield is, what your expected county yields are, what your expected marketing year average prices are, what those reference prices are. And so the decision aid that I want to just introduce you to today in terms of looking at making that decision is one that's out of Texas A&M, their Agricultural Food Policy Center. Their decision aid is a web-based system, and I'll kind of run through that with you. The website's up there for you, and it's a little bit different than some of the spreadsheets decision tools that you've seen in the past, in that this actually does consider some uncertainty with respect to prices, some uncertainty with respect to yield, and does factor that in terms of computing expected payment rates. The information that you need is your farm location, the county and the state, the crop that you're talking about, because this is a crop-by-crop decision, your 2014 PLC payment yield, because that's what is going to be applicable to 2019, but then also for that yield update decision. Of course, your base acres. The historical irrigated percentage goes into the Ark County formula, and for that PLC yield update, looking at the historical planted or prevented planted acres from 2013 to 2017. So that 2013 to 2017 is the time period for that PLC yield update, if you so choose to make that update compared to what you had for your 2014 PLC payment yield. So looking at the AFPC Farm Bill decision aid, you start with, and I apologize, some of these are a little bit small, but I'll kind of walk you through, just want you to see an overview of the ease of use of this tool. You start with the login page. From the login, you're given an option to put it, you have to put in an email address and a password, but that's the extent of sort of that personal identifying information that goes in there in terms of just demographics or what have you. It's just that email address and whatever password you choose. From there, you're brought into the decision aid, which allows you to click on the new farm button down below, and from that new farm, you're entering your farm data. So it asks for your FSA farm number, but that is a farm number that's not necessarily tied to FSA. It doesn't bring any data in. So for that matter, you can put in whatever you want on that farm number, really, as long as you kind of keep track. The key is just something that keeps track of what the state is, the county is, and the crop, because those are the key components that you do need in there, because the Ark County program does depend on what those county numbers are, and of course, crop by crop. From there, you're brought to 2 decision aid options, your payment yield update and your effective payment tool. So focusing just on the effective payment tool first, You're brought to an area where you need to put in your base acres, and then what your PLC payment yield will be for 2019 and 2020, including your historical irrigated percentage, again, for use when computing the Ark County payment, because the Ark County payment does get split between irrigated and non-irrigated for almost all counties. That's, again, something that's a little bit different under the 18 Farm Bill, where before it was for selected counties, now it will be most all counties that will have that split between irrigated and non-irrigated payments. You also, towards the bottom, need to put in some expected price. And so there is a projected price that's included there from the University of Missouri, the FAPRI expected price, and those projected prices you can load in there, or you can put in your own expected price. So I preloaded in here soon to some 75 base acres, a 4,500 pound PLC payment yield per acre for 19 and 20 on saying 100% irrigated for this example, using the projected prices there of just over 22 cents for 19 and 20. And you see there then at the bottom for peanuts, the difference between the PLC program and the ARC program. Of course, no payment on the non-irrigated peanuts. It would be expected because I assumed 100% irrigated. And you see there certainly the preference would be towards that PLC program, which is what we would really expect given that reference price. This is a little bit different. This one would be for seed cotton, and I point this out because there's a warning that's there in the middle, and that's something that's different for seed cotton relative to the other commodities and the other crops that are included here. And so I'll just kind of blow that up a little bit for you. The historical yields from 13 to 17, they must be based on that seed cotton per acre. Now, seed cotton is a combination of cotton lint and cotton seed, and so what you need to do is take that cotton lint yield and multiply that by 2.4 to get your seed cotton yield. So it's important that when you put in the PLC, the 2014 PLC payment yield, that should be already reflected of the seed cotton yield, but make sure that it is multiplied by that 2.4. So in my example here, I have a PLC payment yield of $19.99, so 800 and some odd pounds per acre of cotton lint. That ultimately transforms into a 1,999 pound per acre seed cotton PLC payment yield. You see there again, I left it the same in terms of 2020, so that would assume when I have that the same for my PLC payment yield for 19 and 20, I'm assuming no yield update under that scenario. And I assumed 100% irrigated using the projected prices there that are just under 30 cents per pound. And you see there the difference between at the bottom on seed cotton for PLC versus ARC, and the PLC program under this scenario would be something that would be preferred with just over $12,000 on the PLC program for the 2 years versus $6,000 on the ARC program. This here, the one change that I made is on the 2020 yield, and so if you do the yield update, that does take effect with the 2020 crop year, and so your 19 PLC payment yield would be different than your 2020 PLC payment yield, and then that would be reflected down in terms of the expected payments at the bottom. So the question really comes down to which to choose between ARC and PLC. And of course, the goal here is to really looking for the highest expected payments, but the thing that I want to leave you with is be careful with the blanket determination for all. There is going to be some variation from crop to crop or between irrigated and dry land, and what you did with the last Farm Bill may not apply in the same way. It likely won't. I had a phone call last week already asking, should we just go with the same thing we did last time? And the answer to that really is no. You really need to take a look at it. Do expect a shift towards a lot of PLC, but they're, like I said, case by case because it depends on the PLC payment yield. It depends on benchmark and future county yields. So it's something that you really need to consider and look at for the base acres that you have on your particular farm with what your payment yields are and what your expectations are in terms of county yields and those marketing year average prices. So with respect to the PLC yield update, the formula for that is looking at that 2013 to 2017 period. And you take an average of that period with some substitutions if, in fact, one of those years is less than 75% of the 13 to 17 county average, then you use that substitute yield. But other than that, you're taking 90% of that average, but then on top of that, you're also multiplying it by some national yield factor. So you think about where your average is from 13 to 17, then it drops a little in terms of that yield based on that 90% factor, and then the national yield factor brings it down a little bit more. That national yield factor is that 09 to 12 national yield relative to the 13 to 17 national yield. So you see there the national yield factors for each crop, and you would apply that then to determine what your PLC yield update would be. So within the decision tool that's there, again, pretty simple. You put in what your 2014 base acres are at the top, and down here you have 2013 to 2017 in terms of the number of acres, and then also what your yield is for each one of those years. And it computes, in this case, the comparison of 1999 versus a little over 2,000 pounds per acre. And so that would be a scenario where you would want to go ahead and do that yield update because you would increase that PLC payment yield. An alternative scenario, this one here for peanuts, assuming a 4,500 pound PLC payment yield, given the information that I put in for historical yields, ultimately came out to a potential payment yield for 2020 of 4,390. So that would be a scenario where that yield would actually go down in this case, and then certainly you would not be looking to make that election. Now, once you do make that election on the PLC yield update, it does remain so it starts in 2020 and it remains throughout the rest of the life of the Farm Bill. There are no additional elections or updates in terms of those PLC yields beyond this one. So some final thoughts for you to consider with respect to the ARC PLC election. Depends on those average county yields. It depends on those PLC payment yields, and they vary by county, they vary by farm, so really think about what your relevant yields will be. Also, those calculations depend on those marketing year average prices, that national average price received. Brett mentioned the deadline for 2019 election is March 15th, 2020. And my recommendation is that you don't necessarily need to wait until that deadline, but you don't also need to run out today and say, okay, I need to make that decision immediately, because the closer you get to that deadline, the more information that you'll have. This is one scenario where you will actually have information on what 2019 yields will be. At least you'll know your yields, and you'll have some idea probably from your neighbors in terms of what county yields will be. You won't know exactly, but you'll have some better idea than what we know right now. Also, in terms of the marketing year average prices, again, it will be partially way through the marketing year, so you'll have some idea on where those prices are headed, better idea than where you are right now. So, of course, having a little bit more information can make a better decision in terms of ARC or PLC, but do keep in mind that whatever decision you make for 2019 also does hold for 2020. Less information, of course, available for 2020. After that is when you'll start having that year-to-year annual election opportunity to make an update in choosing between ARC and PLC. So the last thing before I turn it over back to Brett and also open it to questions is just I want to point to the AgEcon website where we do have some more information and more coming in terms of ARC PLC fact sheets, discussion of base acres and payment eligibilities, what's changed in more detail in terms of ARC and PLC, more insight on that effective reference price if you're really interested in getting down to the nuts and bolts of it, and also that PLC yield update. And so I encourage you to look at that as well.
Now I'll talk about the Market Facilitation Program. I refer to this as our tariff program. Now, this was authorized last year in 2018, and we paid producers based on their production. And that program has come back with the 2019 disaster bill. However, there are some changes because this year we're looking at acres as opposed to production. Of course, it provides direct payments to producers impacted by illegal retaliatory tariffs, and that's affecting exports. So that's decreasing farm income on these eligible commodities. It's established by the Commodity Credit Corporation. FSA handles most of funding, if not all the funding, for the CCC. So we're responsible for administrating the program. And like I said, it was implemented in 18, ran very well. Coming back in 2019 with some changes. Sign up began July the 29th of this year, and it's going to end on December the 6th of this year. So payments are available. Eligible persons and entities that have an ownership interest in one or more eligible commodities. These include 2019 commodities. We have several different classifications of commodities. We have non-specialty crops. Those are pretty much your row crops. Specialty crops. Here in Georgia, we have a few great applications that we paid on, but vastly the majority are pecans. There are also dairies eligible under the program, and our livestock that it mentions is hogs that are affected. Now, the payment will be made up into 3 different portions. Now, the first portion, we're already paying it right now. And of course, the trade situation is evaluated whether the second and third portions of the payment are made. The first payment, it was 50% of the producer's calculated gross payment, or $15 per acre. It would make the higher of that payment. And like I said, depends on what market conditions are now, if the trade situation is rectified or not, whether additional payments will be made. If it's not, second payment will be made in November, so next month, and then the third payment will be made in January. And we began issuing payments as soon as payment software opened up on August the 19th. FSA started issuing payments. And producers, if you're seeking to get a payment on a covered commodity, you must have an acreage report for that commodity, a 2019 acreage report. And I always tell producers, because we have some producers that don't participate from year to year in the FSA program, so even if you don't participate, it's a good idea to still come in and report your plantings to what commodities you planted and your acres that you planted to FSA, because you never know what the future holds. It might be a program come up like this program or some other type program, but it's always good to report your plantings to FSA. These payments are not subject to sequestration. That's a reduction, and it does affect several of our programs, but it doesn't affect this program. And the non-specialty crop, like I mentioned, they're pretty much row crops. Here in Georgia, some we have is canola, corn, cotton, peanuts, some sesame, sorghum, and wheat. That there's quite a few programs that are covered. And what this looks at, as far as eligibility for payments, is a producer's planted acres be the lesser of either their 2019 planted acres or their 2018 planted acres and prevented planting acres for 2018. There are some exceptions. If the 19 acres exceed the 18 acres, such as if there was some expired CRP that was put back into production, a new producer on that. For a new producer, you're going to look at the prior producer that had the farm in 2018. You're going to compare that acreage report for 18 versus the 19. Also, any added land, share changes, or entity changes, and then any approved double cropping rotation. That could increase the acres for 19 as opposed to 18. And each county in the state has a payment rate. And these payment rates, these were calculated by some USDA economists. It's basically determining the crops in the county and how they're affected by the exports being decreased. Payment rates are anywhere from $15 for the county up to $150. And crops, to be eligible, the non-specialty crops must have been planted by August the 1st, 2019. And there again, must have had an acreage report on file for 2019 with FSA. And next, our specialty crops. As I mentioned, we have paid some applications on grapes, but majority of our specialty crops are pecans, what we have here in Georgia. Payments are based on 2,019 acres of fruit or nut-bearing plants. These have to be mature enough to be producing. Give you an example, pecan trees have to be 7 years or older producing to be eligible for a payment. And the payment rates for pecans, that's our nut, that's a national rate that's established as $146 per acre. Grapes are 3 cents a pound at 20,820 pounds per acre. And then for specialty crops, as far as determining the acreage, we're going to either use an insurance policy if they were covered, or else an FSA acreage report. Now, if both exist, the FSA acreage report will be used. So that's our specialty crops. Dairy, eligibility under this program, the dairy had to be in operation as of June 1 of 2019. And the payment rate's going to be based on production. And to calculate that production, determine what it is, FSA is going to use the rules for our new dairy margin and coverage program. Whether a dairy is participating in the program or not, the same rules will be used to determine production. And the payment rate for that is 20 cents per hundredweight. And then hogs, relatively simple. There is a date range of ownership from April 1 to May 15, 2009. Producer, when he applies, he's going to pick a date within that range of dates for the number of hogs that he owned on that day. I assume he's going to pick his highest inventory numbers, and it's going to be $11 per head is what he's going to get paid based on those inventory numbers that the producer selects. And this program does have payment limitation. Now it's capped per person or legal entity. Now non-specialty crops has a $250,000 limitation, the same for dairy and hogs. And then the specialty crops are capped at $250,000 also. Now we do have producers that have a mixture of different categories of eligible commodities. However, the overall payment limitation for this program is $500,000. And eligibility, it does have what we call AGI provision, adjusted gross income provisions. It's going to look at your average adjusted gross income for the tax years of 15, 16, and 17. If it exceeds $900,000, then you're not eligible for a payment, unless 75% of that AGI comes from farming. Then you would be eligible to receive payment. And there also is, like for the non-specialty crop, actively engaged provisions. That's just looking at when you fill out a farm operating plan with FSA as far as the number of inputs, capital, labor, and all that's contributed, that FSA determines you're actively engaged in farming. And then there are some highly erodible land and wetland conservation provisions that apply, have to be in compliance with those, and also no controlled substance violations.
So starting in terms of the MFP payment, so this is the second year that the market facilitation program has taken place. The first year was based on your production, actual production in 2018. This year is based on that county planted acres, based on those covered commodities. But there are some rates that actually go behind how the USDA determined what those county rates are. And so they looked at these crop-specific commodity rates based on their analysis of the impact impacts on trade. And so you can see cotton there, 26 cents per pound, wheat at 41 cents a bushel, peanuts at a penny per pound, right? Those are not the rates that you are being paid on. You're being paid at the county rate, but those are the rates that went into determining what those county rates are, based on historical planted acres and historical yields within the county. So if we looked at 2015 to 2018, it was the average of those 3 years for planted acres, and the average of 2015 to 2017 for the county yields, and that was used as a weighting mechanism with those commodity rates to come up with what the county payment rate is. There are a couple of policy briefs that are available on the impact of trade in Georgia and these trade disputes and the trade assistance programs at the CAED website for UGA, so CAED, the Center for Ag and Economic Development.uga.edu, and under publications there are a couple of reports that get into those impacts, even beyond just the market facilitation program, if we start talking about fruits and vegetables and so on. But just looking at what the analysis is, we looked a little bit more at this market facilitation program. The green map on the left-hand side is just a density in terms of what those county per acre payment rates are, so based on the USDA's announced payment rates. And so you can see those sort of cotton and peanut producing areas where the higher payment rates are. And then we also did an analysis on the blue map, which is just for the non-specialty crop, just those commodities, in terms of what the potential maximum dollar amount would be based on a per county. And you can see their ranges pretty significantly, but the darker areas are where there are potentially going to be more payments from the MFP program coming into those counties. Broken down a little bit more, that impact of round two, assuming that all 3 payments are actually made. And so Brett talked about the fact that we've already had that first, the second one upcoming, and the third, depending on the resolution or no resolution of these trade issues. Assuming that all 3 payments are made, the potential assistance totals about $341 million. And it breaks down to about $320 million to non-specialty crop producers. This is just in Georgia. $16 million to pecan producers, a little over $1 million to grape producers, just under $3 million to dairy producers, and $792,000 to hog producers. It does not consider any type of payment limits at all, and looks at what some of those maximums are in terms of those planted acres from 2018, because that is a maximum threshold that does exist, and that's how we did that analysis, looking at what that potential impact is for the MFP program in Georgia. So that's kind of our expectation there. Just want to briefly also mention to you in terms of trade outlook, a few points to just kind of thinking about as we move forward, because these programs are dependent upon the continued trade disputes, which certainly nobody's really thrilled about. The fact that China has started to buy more agricultural products is certainly a good sign. However, a lot of those purchases have not shipped at this point, and so whether or not those will actually ship is certainly a question. Negotiations continue, and so that's just something that, in a meeting of extension economists a couple of weeks ago, some discussions around trade that occurred, a lot of surprise that essentially it lasted this long, but not a lot of hope that it's going to come to any conclusion anytime soon. We did have a new trade agreement that was signed yesterday with Japan, so that's certainly some positive news there with respect to agriculture. On the USMCA, certainly there's some issues on the southeast side that's still in Congress, and if it is going to be signed, that's something that would likely have to be signed within the end of this year, because once we get into an election year, that poses other challenges. But I also want you to think, as you look at these programs, when we talk about trade and trade outlook, right, this does go beyond just these trade agreements. When we think about what the longer term impacts are, there are a couple of things that are at play. One is the fact that these trade disputes have changed some of the dynamics. Relationships play a lot in terms important role in terms of trade, and the fact that these relationships have now changed, where countries have started trading with other countries and different buyers, does change what those relationship structures are. And so when looking forward, it's not that we resolve these trade disputes and all of a sudden it all goes back to the way it was, because those relationships are different. The other factor to consider is increased global competition. Farmers in other countries have been changing their production practices in response to these trade disputes. In particular, you look at some of the crops that have been planted and the amount that's been planted in South America, additional production, and again, that changes the dynamics and longer term creates increased competition. So there are factors, even if we talk about the trade disputes being over and a market facilitation program then disappearing, there are certainly some issues that will be more longer term and long standing that are going to be impactful in terms of agriculture that we need to think about.
Adam said our disaster programs, what we're offering this year, 2 disaster programs. We do have more, like the Emergency Conservation Program and the Emergency Forest Restoration Program. As far as row crops and everything, what we have is the WIP program. Now there's 2017 WIP that was enacted last year and WIP plus for this year for 18-19 disasters. And also added, as I said earlier, that WIP has expanded. Also, we have a milk loss program for 18-19 disasters, and there is an on-farm storage loss program for 18-19 disasters. And last year, when the Bipartisan Budget Act was passed, it created WIP 2017. This was for disasters in 2017 that affected crops. And our eligible event was Hurricane Irma. And so that sign up ended in November of last year. However, with the 2019 disaster bill, it did make some changes to the 17 WIP, and it brought in, well, there's Tropical Storm Cindy was eligible, but that didn't impact Georgia. But for 2017, any peach and blueberry crop losses due to extreme cold, this was the freeze that happened in spring of 17, they're eligible to come in and apply under 2017 WIP. Now, if there was any 2018 blueberry production loss that was affected by the 17 freeze or the hurricane in 17, then they can come in and submit an application as well under the 2017 WIP. Sign up, we begin September the 11th, and like I said, peach and blueberry losses and 2018 blueberry losses could come in and apply. There are some eligibility requirements because the same eligibility is in place as was last year right before the program ended. And one of the requirements is what we call linkage requirement. That means you have to purchase insurance on the crop that you're getting a WIP payment on. Must meet it for the next 2 available crop years of at least a 60% coverage on your production, and the last 2 years to obtain the insurance is 2022 and 2023. And for this program as well, must have an acreage report on file and must meet the wetland compliance and highly erodible land compliance provisions. There's a $125,000 payment limitation per person or legal entity. However, this is also looking at your AGI. If you 75% or more of your income for 13, 14, and 15 averaged, your average AGI is derived from farming, then you could receive up to the $900,000 limitation. That was the same as last year. The WIP formula, this is just the basic formula. There are a few other things that go into this, but the basic formula is the expected value, pretty much like your yield times acres, then multiply by the WIP factor, and I'll show you the WIP factors on the next slide. That equals your WIP value. Then you're going to subtract any actual production that was made minus any indemnity payments, whether they be from RMA crop insurance or from FSA, from our non-insured crop disaster program, our NAP program. And then also any salvage value that would be subtracted from the gross payment. So the factors, still using last year's factors. Uninsured, it starts at 65%. Cat level, basic NAP, that's 70%. And then as the insurance increases with buy-up goes up to 95% is the highest payment factor. You want me to continue with WIP Plus? Okay. All right, now I'll talk about WIP Plus, as it's called. This is for 17-18 disasters. And this was authorized under the 2019 disaster program. It operates similar to 2017 WIP. Of course, the years of loss have changed. There's additional qualifying disasters. Also, there's different payment factors. Actually, the payment factors have increased for WIP Plus. And of course, it provides assistance to crop, tree, bush, and vine losses due to hurricanes. You know, our eligible events here in Georgia are hurricanes and tornadoes. And in 2018, of course, we had Hurricane Michael, and then we had some tornadoes, and we may have some tornadoes in 2019 as well, but those are qualifying events that if, like I said, crops, any trees, bushes, or vines were affected, then they're eligible to come in and apply for the program. Then as a condition, if you receive a WIP payment on a crop, then you'll have to meet that insurance linkage as well. Of course, the next two available crop years, consecutive crop years, are 2022 and 2023, and it's the same that you have to have at least 60% coverage on your production. The only exception under WIP Plus is any trees, bushes, or vines. If insurance was available on those, they do not have to purchase it under WIP Plus, like con trees. Under the prior WIP program, RMA did have a con tree insurance policy available. You were required to purchase that if you got payment on the trees. So that's no longer a requirement under WIP Plus.
What if you don't farm in the next 2 years? Are you ineligible then?
There are certain situations, you have to talk like your county office, if you still don't farm, or like if you don't plant the crop, then you wouldn't have to meet linkage under that. But I would contact the FSA office and talk with them about it. So.
Is CAT coverage considered insurance?
Well, it's insurance, but it's not 60%. It's like 50-55%. You got to have at least 60% coverage on your production. So. All right. Also, have to have an acreage report for WIP Plus and meet the highly erodible land and wetland compliance provisions as well. And what the program pays for is for insured crops, non-insured crops, that'd be covered under FSA's NAP program. Because NAP is offered if crop insurance does not offer insurance in a county on the crop. Then, you know, FSA could sell our insurance to cover that commodity, which we do a lot of vegetables through our NAP program. Also, any uninsured crops, of course, these have to be crops that could be eligible to get insurance, however, the producer chose not to insure them. So, you're looking at eligible crops as far as payment that were planted or prevented from being planted with the intent to harvest. And here's the WIP payment formula again. It's the same as the prior program. Nothing's changed on the formula. However, on the WIP factors, they have increased. Uninsured has gone up to 70%, and then like basic CAT coverage, catastrophic coverage, NAP coverage is 75%, and still the top tier of the payment factor is 95% based on your buy-up coverage that you purchase for RMA or under the NAP program. All right, payment limitations. This payment limitation is $125,000 per person. It does also look at your adjusted gross income, just like last year. If 75% or more your average AGI is from farming, then you can receive the top payment rate if you qualify. and that's $250,000 per crop year. And that was an overall $500,000 payment limitation, because you're looking at disasters that occurred in 18 and 19, and then say 19 disasters affected production into 20. So, but for those 3 years, you can only receive a maximum of $500,000 in payments.
This first example here is for a farmer that has a single enterprise unit crop insurance coverage. Okay, so there is crop insurance coverage across multiple farms that are irrigated and dry land combined together as a single enterprise unit. So the irrigated land is covered at $5,100, the dry land at $65,100. And you can see there in column A, the acreage, column B, the APH yield history, in column C, the actual yield. In some cases, that yield was less than the APH yield. In some cases, it was actually a little bit higher. The price that was used there was based on the crop insurance documents, the crop insurance level, 50% or 65%, and then that 100% price was what was elected. That WIP plus lookup value is the crop insurance level, that percentage multiplied by the crop insurance price percent. And so that gives you the value that gets looked up in the tables that Brett showed you before to get your WIP plus factor as shown there in column H. So those factors for the irrigated land in these cases are 77.5% and then 85% for the dry land. You see there then that WIP plus value that's based on the acres multiplied by the APH yield, multiplied by that price, multiplied by that WIP factor. So that's what WIP is expecting you would have received as some type of value for your crop. Full value, essentially, that WIP value. The actual value that you did receive, though, is based on your acres and the actual yield that you obtained, again, at that particular price. Everything is evaluated at that crop insurance price. The difference between those two, the WIP plus value and the actual value, is where you get what I call the WIP plus gross payment. And I call it gross payment because what this does not consider is it doesn't take into consideration any indemnities that were received for crop insurance. It doesn't take into consideration any secondary or salvage value. And there are a few little adjustments to the basic formula that sometimes need to be made depending on crop share or late planting deductions and such. Makes it more complicated in terms of that calculation. You see there in terms of some negative numbers for that gross payment, and that's where there are some farms where the actual value ends up more than the WIP plus value, and that's that offset that's occurring. Because all of this gets combined because it was a single enterprise unit. All of this gets combined, and even though you have a lot more positive than you have negative, ultimately it brings that down in terms of what the WIP gross payment is. Take that and then deduct off what those indemnities or any additional value that you received for that crop before you get to your actual WIP payment. So my point here is, how does this compare if this same farm, same situation, was uninsured? No crop insurance at all. And so that's the one thing that I change in this example here, example 2, to uninsured. And you see going down from that $26,000 WIP gross payment to about $3,000 WIP gross payment. So question becomes, in terms of the actual payment from WIP that's received, depends on what that indemnity was from the crop insurance. And then that gives you what that additional would be for having that coverage. You see there the WIP factor for insured at 70% across the board for irrigated and dry land.
Like I talked about, WIP has expanded, and one of the things that was added for 2018-19 disasters is the WIP milk loss. This kind of runs like, we have a existing dairy program now called Dairy Indemnity Program. If milk has to be dumped and due to like aflatoxin or something, then it would provide a payment to that producer for any uncompensated losses they had. This program pretty much works like that. like I said, it provides payments to eligible dairy operations that had to dump milk without compensation from the commercial market, and the eligible causes of losses are the same as under WIP. You know, we're looking at hurricane, tornadoes, primarily here in Georgia. To be eligible, I said you had to dump the milk removed from the commercial market, qualifying disaster event in either 2018 or 19. If the producer was partially compensated, that does not knock them out of the program. They can still apply for any uncompensated pounds of milk they didn't get paid on that was dumped. A couple of other things, they have to be in compliance with a highly erodible land, wetland conservation provisions. Now, this program does have an application closing period of no later than February the 1st of next year, 2020. So applications need to be filed by that date for this program. And the eligible period, it starts the day that milk was dumped, not shipped on the commercial market, and ends the last day that it was dumped. And the program provisions, it's 75% of the market value of the dumped milk, and this is going to be a national payment rate, is going to determine that market value during that time period that the milk was dumped. Limitations are 30 days for claims in 2018 and 19. You're limited to 30 days for 18 and 30 days for 19. Payment limitation is set at $125,000 per year, and adjusted gross income provisions does not apply to this program. And payments calculated using the number of days that the milk was dumped times the fair market value. Of course, off the gross payment, have to deduct any transportation and hauling fees and promotional fees. I think I did forget to mention, it will be based on production, and I don't know what happened to my slide there. It will be based on production, and the production will be calculated using FSA's new dairy margin coverage program. That replaced the program that we had in the last Farm Bill, the margin protection program. Now, even if a dairy is not participating in the DMC program, you're still going to use the same rules to determine production. So that's what production is going to be paid on for the program. So it's a fairly simple program once you determine the production, the value of the milk, the days that it was dumped, and then you figure out the payment calculation on that. Okay. Any question about the WIP dairy program? Okay. And another new program under WIP is On-Farm Storage Loss Program. This was created by the 2019 Disaster Program. And it provides payments to eligible producers who suffered uncompensated loss for harvested commodities stored on on-farm structures, resulting in, here again, hurricanes and tornadoes in Georgia that occurs in calendar years 2018 and 19. Acreage report is not required for this program. We're looking at a harvested commodity. Payment limitation is $125,000 per calendar year. No adjusted gross income provisions apply to this program, and it's not subject to sequestration. So, producer would come in, file an application, they'd certify to the losses, and the structure may or may not be in existence due to the severity of the disaster event, hurricane, tornado. And this is not a payment for the damaged or destroyed structure like grain bin. I mean, we're not paying for the bin itself, we're paying for the crop that was in the bin at the time of the disaster. So there's no disaster declaration needs to be declared to support the weather event that occurred. And some eligible commodities, of course, a few here in Georgia is corn, cotton, looking at grain sorghum, hay is eligible under this program, peanuts, soybeans, wheat. And the eligible structures, of course, the structure had to be a structure that would maintain the quality of the commodity from harvest until marketing. and the structure is on farm. It's not used for commercial purposes. It's not storing other producers' commodities for a fee. It's just strictly on farm storage used by that farming operation or that individual producer. And as I mentioned, the structure may not be in existence when the producer files an application, but the local county committee will make a determination based on their knowledge or knowledge from the community whether it was a sound storage structure at the time of the disaster. And the payment rate, there's a FSA national payment rates for the different commodities, and these rates are based on marketed and harvested prices, and then it's going to be the payment rate times the quantity of the commodity times 75% payment factor. And producers may submit multiple requests for payments. Could be multiple disasters happen within a year. I mean, you can come in and file. Losses must be recorded separately for each calendar year, and the application may include multiple commodities that were affected. And commodities could have been commingled. You know, several producers storing their, say for instance, bushels of corn in a grain bin. They can come in and apply individually for the program. However, you know, FSA will, or the producers will have to let FSA know how many bushels to allocate to each producer. So, as I mentioned about payment rates, I didn't have those on a slide. They're quite numerous, and you couldn't see them if I had them on a slide. They're so small, but for program information, there's two websites that you can go to. There's farmers.gov. This is probably a website that's a couple of years old. A lot of information is being put on this. I think it's got like a survey thing that you can get on and take, and it will direct you in what programs that may fit you in certain situations like disasters. Eventually, this website's going to have it where producers can go in and start an application, and then the local FSA office will be notified that you have submitted an application, and then you would come into the office at some point and finish the application. And then the FSA does have its own website that we have a lot of our program information on as well. I mean, you can go on and get things such as like our program notices that we use about policy. Also, our handbooks are available on there, so you would be looking at the same policy that our FSA county officers look at when they do applications.
So that's the information that you can get from your RMA agent. If not, sales records, anything you may have to prove your 2018 production. The tariff program, the MFP program, most of those payments have gone out. We're finalizing a lot of them with pecan acres on them. There was some controversy over the acreage, and we've got all of that finalized. So we're about 90% through with the tariff program as far as the payments. There's been some issues with funding into the accounts, and we've held approvals and payments for about 7 to 8 days now. So hopefully that will be lifted this week, and those payments will go out next week as well. Row crops, if you're insured and you had a claim or loss record, we've got all your information as far as WHIP Plus. You just come in the office, and again, the gentleman talked about signing the yellow pad, the register. With insured crops, we got your information. A lot of time they have what they call an SY record, and we can use that for your production. Now, if you're uninsured, we're gonna need something. We're going to need sales receipts, anything that you can use to prove your 2018 production. But to take up, I reckon for the county office employees, it takes 2 to 3 hours to work a WHIP application, just one application. That's a routine application. We've got everything from crop insurance. We don't have to dig a lot of records. It takes 2 to 3 hours an application. So it's a very lengthy manual process. And again, not making excuses, but that's just the nature of the beast. So with that, that's the information that we'll need for 2019 as far as ARC PLC and your WHIP Plus applications is pecans and your production side.